lot of enthusiasm and confidence behind the pickup in transactional activity last year. I think from the figures I've seen, UK transactional activity was up to around 6.3 billion from about 3.3 billion the year before, and clearly the years before that affected by COVID and that sort of thing. So there seems to be a lot of confidence being expressed in the press about transactions moving forward. Same across Europe. I think 20 billion last year was the transactional side of things. So I guess the question is, is that confidence something which is properly supported? Is that what the panel are also seeing? So, Tom, I'm going to come to you first, if that's okay.
Sure.
In terms of performance data, what are you seeing? Is that confidence justified?
In terms of the performance data, I think so across Europe. If we look at what we've done as an industry, looking back at 24, we saw occupancy across Europe up by 2%, and we saw rates grow 4%, and that's obviously off the back of significant rate growth, as we all know, over previous years. And I think when you start to dive down into that as well, and you look at that occupancy and you compare internationally, which is always important to do. We can talk about just Europe, but we need to think about what's happening across the rest of the world. We're sitting at 70% occupancy as an industry. The US is at 63%. We've got effectively the highest occupancy of any region globally. As I said, the rates are continuing to go up. And then when you start to dive down into that data a little bit more, I think there's even more confident or reason to be confident. So if we look at where the growth has come from in 24, where it's actually grown is during the week, is that Monday to Wednesday. So that is indicating more corporate travel coming back. We all know leisure recovered quite quickly in comparison. Corporate took longer. So that's obviously a positive. If you start to look at the segmentation data as well, groups, okay, we're still below 19, quite some way. We're about 20% below from a group perspective, but it's growing quite neatly. It's now nearer 19 than it is in the States again. So that's positive. If you look at some data from our friends at Tourism Economics, for example, expected international arrivals, Asia-Pacific international arrivals into Europe should exceed 19 levels this year. For China, it will be next year, but that's obviously a big source of demand that still isn't recovered, and we're still achieving these results. I think as well, just two more points I'd make on that is events. Europe is an event mecca. We do it very well. We've got the infrastructure to do it. We'll always host these mega events as such. And if you look back at 24, we had the Olympics in Paris, we had the Euros in Germany, we had Taylor Swift, God love her. She did amazing things, as we all know, for our industry. So we do that very well. And then just the last point, which I think is important to make from the performance perspective anyway, is about supply. So if you look at Europe as a whole, and obviously things are different in different markets, but if you look at Europe holistically, in construction pipeline is just 2.7% of existing supply. And if you look at the full pipeline, it's 4.1% of existing supply. Now, not all of those rooms are going to open, and those that do aren't going to all come at the same time in one mass flood. So actually, I think from a supply perspective, the supply-demand equilibrium for Europe in the coming years ahead is also something that we should be pretty positive about. So if you put all of those ingredients into the melting pot, I think it justifies.
Yeah, okay, great. I'm going to come back to the supply point a bit later. But I wanted to come to you, Rebecca, after that, because you're effectively at the front end placing capital looking to acquire. I mean, what's your perception of the market at the moment? Where are you looking to place money?
At the moment, I think it was an interesting economic backdrop to what's happening in Europe. We have a lot of strategies in the UK at the moment, as well as Germany. And interestingly, even though Germany looks like a complete basket case at the moment, we actually see a lot more opportunity there to get in with less competition, cheaper financing costs, and a lot of operational know-how in a very mature market in Europe, which is what we do as a business. We back new operators that are coming together, so very experienced teams, but new platforms, new brands, and we provide seed capital in a venture-style way to help these new businesses launch their new brand to the market, but also get a few assets open and operational to prove the concept. That then allows them a whole other universe of institutional capital that will come in as growth, private equity, or institutional money as joint venturing or forward funding, future pipeline. And so we're not only bullish on the market, we're also taking very early stage risk in a venture capital way in establishing these new brands in hospitality and across living. The reason why we've started focusing on the UK actually is because of pricing. We've seen pricing shift in the UK a lot faster than everywhere else. Part of that was fueled by the political issues. Our family office backing means that we actually can take a longer term view. So a lot of geopolitical risk is a factor in the short term, but if you're taking a 10, 15, 20-year stance on the market, you know, geopolitical factors are less relevant to our decision making, I would say.
Yeah.
We also really like the fact that, again, going back to the operational expertise, the UK and Germany, you know, has some of the best operators that have been performing for a very long time with individual track records, and that's also really helpful when you're backing new teams. What's really unattractive at the moment for our investors is taking any kind of planning risk in the UK. So we've seen, you know, even in the hotel strategies we've looked to invest in, if there's any kind of new build or even extension that requires planning, investors are extremely cautious about that.
Yeah.
And also increased financing costs in the UK don't help our returns at the end of the day.
Understood.
So
Do you just see that as a UK issue, or is that, I mean, you're obviously more
mainly
broadly-
a UK issue, because we just don't know how this government is going to feed through at the local level as far as getting these consents. We could, you know, be waiting a very long time for consent, so planning risk is very, very tricky in the UK. More so, I think, than anywhere else in Europe that we've seen.
And sorry, just to pick up also on this, and we'll come on to others. Are you seeing much competition in the market in terms of if you're looking at assets? I mean, is that...
Now, for what we're looking at, no. Most of it is, we receive a lot of off-market, everyone says off-market, it's traditionally not, but we do receive a lot of pipeline through our operating platforms, and because they're on the ground, and vendors traditionally, especially if you're buying sites, like to work with end users rather than traditionally, you know, private equity groups or institutions. So actually they unlock incredibly good deals. Most of it is, you know, if we're looking at land, subject to planning, thankfully, so the market is still favorable to doing subject to planning deals. We do get a lot of pipeline through the operating businesses, and fortunately for us, being family office money, we see a lot more opportunity given the institutional capital has largely been on the sidelines for the last couple of years.
Yeah. Okay.
So that's a big advantage for us.
Thank you. Dimitri, I'm going to come on to you because you're obviously looking at this from a slightly different angle at Wyndham in terms of investment, but nonetheless looking to expand presumably as quickly as possible. How are you seeing things?
Look, first of all, it's worth coming to the conference to see Greece as a star performer, to start with. I just want to make sure that I make sure everybody noticed that. Obviously, being Greek, this is very proud, thinking about 10 years ago that we were the black sheep of the European Union. So that's a thing. It means that things can actually turn around. So a lot of optimism there. Look, we are extremely bullish in the European market, right? I mean, we buy brands. That's how Wyndham grew to where it is today. We're the biggest franchisor in the world. We have 25 brands. 20 we actually bought. 4 we created. 1 we licensed. We bought Vienna House 2 years ago. We're looking at new opportunities in Europe. I think Europe has a leadership responsibility as well. When diversity, inclusion, and sustainability is becoming less of a topic or less of an important focus in other parts of the world, I think European hospitality, brands, operators, we need to look at sustainable hospitality and diversity and inclusion within our business. So we look at businesses that they actually tick the box and they have very strong practices and focus on those areas. We look at businesses in areas like India. India for us, it's an enormously important market, not just for India. There's going to be, I mean, to your point about who's going to travel next, there's going to be 150 million middle-class Indians that they're going to travel around the world, and Europe is going to be their number one priority. 820 new planes have been ordered by Air India and Indigo Airlines. So outbound travel, you got to invest in markets that you build the momentum so you're there when the outbound travel actually happens. I think the CIS, we are very bullish about the CIS. We see We're growing fast in Kazakhstan, in Georgia, in Uzbekistan, in Kyrgyzstan. Why? Because of the Chinese belt and the Chinese investment over there and the Silk Road. We see some great RevPAR there and some really beautiful hotels. And obviously, I will agree with you. I mean, Germany, we bought Vienna House. We just done a deal. We just opened another 10 Vienna houses in Germany and in Central Europe about a week ago. Germany, for us, it's for exactly the same reasons that Rebecca said. Despite the challenges, they're an amazing opportunity market because, despite the consolidation, you had some bankruptcies, you had people going out of business, but that wasn't because just the market is not good. It was, lack of management and high risk. I think people who are going to be cautiously optimistic, as Andrew said, people who have a good business and they have a solid foundation, I think they're the people who are going to survive. They're going to have a great future. So we as Wyndham, we're definitely going to be looking at those opportunities going forward.
Yeah. Okay, no, that's interesting. And are you seeing differences between different segments? And I say that partly based on comment. I mean, a lot of the transactional activity that was seen last year was, increased volumes, but a lot of it was big portfolios, large single asset transactions. And I've read comment that there's a lot of confidence in the luxury segment of the market and also budget, but maybe not quite so much in the kind of mid-scale. So,
yeah, I mean, we're among the leaders in the premium economy and mid-scale, right, with our brands. And luxury is 10% in the world, right? And we are very focused on the rest of the 90 or 85%. I think that again, Europe has a lot of innovation. A lot of interesting brands are coming out. A lot of interesting concepts. I'm very fascinated personally on that whole student accommodation and flexible living and serviced apartments, what they call extended stay in the United States. I think this has enormous opportunity. Office conversions, brands that they can easily convert into asset class or leisure real estate. They have a great opportunity. And the other thing is revenue per available square meter. The whole RevPAR story, it was good and it got us going up to today. But now, if you have a ballroom with 2,000 square meters and you use it once a year, what's the point? So revenue per available square meter and concepts, ideas, and brands that actually make that happen, for me, it's the most exciting thing that I've seen in Europe in the last couple of years.
Yeah, okay, no, that's interesting. It's a lovely seg for Wouter as well, because one of the things that clearly is, and we'll come back to this perhaps a little bit, but potentially a drag on the market has been increasing cost and that sort of thing. Your focus is actually on property management systems and helping the kind of technical side, if you like, of the sort of back office, so to speak. What are you seeing? Are you seeing people really investing in that side?
Yes, I think it's both increasing costs and also the increasing need to generate additional revenue, like Dimitris is saying as well. I think it's both. I think from a technology point of view, the hotel industry isn't always seen as the most as front runners. They're quite lagging in adoption of technology. But I think there's reasons for it. Technology hasn't been great necessarily. There's a lot of different pieces of technology that you need to utilize in a hotel or in any other accommodation. And it's a business that's open 365 days a year, 24 hours a day, and so you can't
continuously adopt new technologies and shut down systems and pull something out and plug something else in. It needs to be seamless. And coming from a technology company, we haven't always been the best in that, but I think there's a lot of improvements happening there, right? So we're finally seeing this move to the cloud, which is making a massive impact. We've been talking about it for probably over a decade, but it's really happening now, and the speed of change is really increasing. So that's a positive, because it helps to implement new technologies and much more rapid change and integrations of different systems. So that's a good thing. And it's really needed now, because, like you said, the costs are really high. Turnover rates are high in hospitality, and so technology, we're not looking at technology as a replacement of humans or the human touch or sort of the hospitality in hospitality. It actually is an enabler of that. So If you think about the amount of mundane tasks that people are doing and how much that costs, going up to a front desk and having to give your passport and your credit card and this person having to type all of that in, even though you've booked online and you've given all those details already. So why do you need to do it again when you're at the hotel? It costs money, the guest experience is terrible, and so technology can do all of that. And you've got online check-in, you've got kiosks, you've got digital keys that can do all of that for you. So why does the hotel industry not do it when it's hard to find the staff to actually do that kind of work, especially with the pandemic, people moving out of the industry and not necessarily coming back. And so costs, technology can really reduce or increase efficiencies, maybe even more back of house than the example that I gave. Plus, as Dimitri said, it can really help the industry to generate additional revenue through revenue management systems, through utilizing every space that you have. And I include in that anything you can upsell, from rental bikes to pedal boards to tennis courts. Anything you might have in or around your hotel should be bookable by the hour, dynamically priced. And so technology today can really help with that. And investors are looking for that kind of efficiency.
That's interesting. My observation is that technology is usually pretty expensive, and that may limit the number of investors that can actually buy into that. Now, I don't know whether that is a good thing or a bad thing, maybe particularly for brands and that sort of thing, central distribution systems and what have you. I don't know, do you have a view on it?
It's a must. I mean, we just cannot live without it. So again, to Vida's point, I mean, 10 years ago, we used to do most of the things manually. Now technology actually helps you use people in a more constructive way, right? The receptionist can actually be an experiences officer, can be somebody that can actually add a lot of value in the experience that the guest has in the hotel, instead of just looking down on a keyboard and typing people's names. So the challenge with technology is that if we oversell it, then people will say, why the hell would I work for an industry that is going to replace me with a bot or with I don't know, a kiosk? We have to give that balance that technology actually doesn't replace, exactly to your point, doesn't replace humans.
Yeah.
The human touch in hotels, it's 5,000 years ago, it was exactly the same thing. The Greeks invented hospitality, so we know about it, right? so we know how it works. It was 5,000 years ago, it was exactly the same thing. It was humans serving humans. So yes, the technology cannot replace the human touch.
I'm glad that this has all been clear for the last 5,000 years.
Yeah,
definitely.
And on the cost of things, I think technology is getting cheaper. It's getting more with the cloud, with AI coming in now as well. It will get cheaper. Also, the hospitality industry spends about 4% of their revenue on technology. You look at other industries, retail 7%, banking 10%. So a small increase will have a big impact. And what people experience in retail, in restaurants, in banking, they'll expect in hotels as well. And so once a consumer sees something in a different industry or in their daily life, they would expect the same in hotels. And so we can't run an operation where when you check in for a flight, everything is done online. When you can do all of your banking online, but then you come to a hotel and you have to stand in a half an hour queue to check in for your room to get a key. That's not what people expect anymore.
But also from a pure investment perspective, you need to build future-proofed businesses and assets, right? If you're looking at, we're always thinking about our exit and liquidity. Is anyone ever going to buy an asset that's not still going to be viable and operating efficiently for the next 10, 15, 20 years? You're just not. So it really impacts the liquidity of your assets and your businesses, as well as thinking about it not as a cost, which we advise a lot of operators and landlords and big real estate investors to think about it as an investment. And it has to be somewhere else on that line item, because in your cash flow, because there is a discernible ROI on that investment in technology. It should not just be considered, well, this is a cost that hits my OpEx and it's harder for me to, meet my margins or whatever, the criteria is. It's an absolute must. You have to think about your liquidity on exit and future proofing.
Yeah. That's interesting, because that leads me on to another point I had in the back of my mind, which is, one of the other costs that has been sort of gradually coming into particularly the investment side is obviously on ESG. Not that this session is particularly focused on that, but I wondered whether, so we have President Trump being elected in the US and maybe sort of beginning to turn his back on some of these things a little bit. I just wonder whether that's going to change the way in which investors look at the requirement to keep ESG coming on board, to spending money on that side of things.
I think the whole anti-woke Trump-Musk movement is temporary, hopefully. But when you actually say it out loud, I oppose diversity, equity, inclusion, it sounds absolutely ridiculous because it benefits all of us, not just individually, but society as a whole is dependent on it. I think, especially from a hospitality service perspective, if you're not focused on the diversity of your workforce and your businesses, you're in trouble. But not only that, it makes good financial sense to invest in more diverse teams and people, and as we know, it's proven to raise productivity and profitability of all businesses. So it's one of these things that we've turned into an acronym like ESG and DEI. We made it into something political, which it absolutely is not. I think if you strip it all back, we need to be delivering to the market assets and businesses that are better for society in general, better for the environment, and better for, the health and well-being of the people in which we serve, which are our customers. So we have to just completely ignore all the nonsense, frankly.
I've got two teenage daughters. One is 27 and the other one is 25. And they keep on reminding every day that doing the right thing, it's not a political thing. Doing the right thing, it's just simply doing the right thing.
Yeah.
I think everybody in this room knows what the right thing is in their household and in their minds. If we do the right thing, we don't have to make it a political conversation. We have to do the right thing for the next generation. We have to do the right thing for the planet. And I think investors and operators, they actually know that. Because I will never forget, we had a guy who owns one of our hotels in Lucknow in India. And people think of India that there's a lot of pollution there, which it is, and they don't care about sustainability so much. And we have a program at Wyndham, we call it Wyndham Green, and he's on top level 5, and he spent millions on it. And I just asked him one day, I said, why have you done it? I mean, you spend all that money. Does it make sense in your environment and in your investment? He said, I didn't do it for you. I didn't do it for the brand. I did it for my kids. So doing the right thing, it's not about politics. It's about what we consider as an industry and as individuals and as brands and operators doing the right thing. Yeah. So that's my view. It has nothing to do with politics.
No, but it's interesting. I mean, again, although I don't think that there is a valuation line, for instance, that goes to ESG, nonetheless, I think that's something that future-proofing of property is something 100%. That's undoubtedly part of the equation now. Are you seeing any of that in what's driving, people wanting to invest on the, property management systems and that sort of thing? Are you covering the sustainability side and those sort of softer elements?
Yeah, we have integrations. So I think the main thing that we see with technology now is that we're opening up to other companies to use the data from the hotel, and we are seeing more hotels looking into sort of environmental management, climate control, and these kind of types of integrations. We have a hotel for trees integration, which is a company that allows hotels to ask people whether they want to change or get their room cleaned every night, and if they don't, we plant a tree basically, and our system is integrated with that, so it all gets automatically registered. And actually, a few of my colleagues went, I think last week, somewhere in the Netherlands to plant a number of trees, but we're their biggest partner because everything is automated, and we see more and more hotels obviously being interested in finding ways to be more environmentally friendly,
to think about their impact they're having on their local communities, on their staff, on all these things, and making sure that they do the right thing, as you said. And so we're trying to help with whichever way we can through technology to make that as seamless and as barrierless as possible.
Yeah, okay. So, Tom, is that something that people are asking to see in kind of performance data as well at all? Is there a trend that you can see there?
I can see reason why they would, but being honest with you, we're not having we're not having too many conversations. But what we are looking at doing is looking at sustainability benchmark, and there's an active project going on at the moment to look at that. And there was some data that came out, a company called Greenview that we were partnering with, I think the Singaporean company, and the difference between the carbon emission per occupied room for those at the, maybe to your point, Demetrius, the chap in Lucknow, minimal carbon, and then we had some that were, it was crazy. I think it was, there was, those at the lower end, it was 5 to 6 kgs, and then those at the top end, it was 200 kgs. I mean, I remember we put some slides together. It was sort of the difference between a cabin bag that you'd put above your head on an aeroplane, the weight of one of them were in those better performing, and then it was a grizzly bear. Like that's the emissions from those at the top end. So the differential was enormous. So it's definitely something that we would like to do more on. Obviously, collecting that kind of data has its challenges, but I think it's definitely got a place in the future for sure.
Yeah. Okay. Just coming out of that sort of detail again, and sort of heading back into some of the kind of geopolitical stuff that's going on. I mean, how much do you see that as being affecting your decisions as to where you want to invest and how quickly you want to invest? I can throw that out to.
Yeah, I mean, we have a huge presence in the United States of America, and 6,700 hotels. The infrastructure development, the Biden administration, the Trump administration, the 4 data centers that they're building, it actually benefits. It benefits our presence there. We've got. I mean, for those of you who don't know, we've got premium economy with Days Inn, Super 8s, and Ramadas and La Quintas. Every 10 minutes, you can find one of those in the U.S. highways. So all this infrastructure movement, it actually reflects on our growth. We've got tremendous opportunity. We entered the extended stay with Echo Suites by Wyndham, which is a new build extended stay. We have 200 of those already commissioned, 10 they've already opened. Extended stay in the United States with all this infrastructure development is going to be huge. So you've got UK and European factors now going into, or brands going into America to actually establish factories. So you cannot ignore it. It's actually a huge part of your story, right? Of your investor story. How the infrastructure development is going to help the share price, and it's going to help growing the real brands. On the other hand, you've got the other side of the coin, what's happening in Ukraine, what's happening in the Middle East, and you've got to balance. You've got to balance one with the other. But if you're a global company, and that's the good and the bad, you win in one side and you lose in some other side, but you have to have a balance at the end.
So are you net positive or net negative?
I think we're net positive.
Right,
our share price was $69 a year ago. Now it's 108. So I hope you bought some.
Okay.
What's your best performing geography and brand?
I would say Greece. No, I'm only kidding.
I'm expecting.
I'm only kidding. No, we're doing. I tell you what, we're doing phenomenally well in China. We've got 1,500 hotels in China. We're doing phenomenally well in China. Obviously, the United States because of everything that I said. But I guess the Med has been a huge benefit for us. Spain, Portugal. South of France, Turkey.
American tourists?
Yeah, I mean, amazing. I mean, in Turkey, we have 130 hotels where number one international brand there is doing phenomenally well for us. It's just, you gotta take it in the chin, right? There's going to be a curveball every single day. My team tells me, what is the strategy for next year? I said, I don't even know the strategy for tomorrow. You just switch on CNN and there's another curveball and you're like, oh my God, how did that happen? So you gotta live by the day. So, but I think the Med is gonna continue to do well. I think Turkey is a great market. China and what I said about the US because of the infrastructure development. So
I think we're running out of time here, but the last question is literally one word answer. So I'm going to ask each of you, net negative, net positive. Where are you? Positive. You confirm? Positive?
Absolutely positive, yeah.
Same, very positive.
Okay, well there we go. There you have it.
Any questions after, let us know. Thank you.
I did want to open up to the floor for questions. I've got one though before I roam around with the microphone. You've got a diverse set of people here in terms of, you're very different to the usual investment outlook panel. And I'm going to ask you a typical investment outlook panel question, which is what you think the deal flow is going to be in the coming year. So the consensus seems to be that last year, really good. We had a pretty good volume, but the single asset not so hot. And the consensus most people I talk to for next year is that the actual overall volume probably a bit down on 24, but we're going to see much more of that single asset piece, that bedrock piece, getting things shifting. So let's go through the panel, starting with Tom.
Can't disagree with what you've said, to be honest with you. I think that sounds apt. We know it's been very slow on the single asset, so it's very likely to increase, and what we see is all pointing in the right direction. So I think that synopsis, Andrew, for me, I can't disagree with it.
For me, I think the opportunity lies in the family-run business. I think the second generation has less appetite to inherit that business. Traditionally, Spain, Portugal, Greece, Turkey, Cyprus, Italy, they've all been, family business. I think second and third generation had enough and they just want to have a good life. So you're going to see a lot of those businesses coming for sale. Portfolios, assets, opcos, propcos. I think the next 2 or 3 years, you're going to see a lot of that over there.
Well, we've been tracking $300 billion that has been raised by the top 25 institutional funds that needs to be deployed in the next 5 years. A large percentage of that will be beds, living in hospitality sectors, which made up a quarter of the market last year, which is the highest of all time for the bed sector. So I think it's extremely positive, given there's an enormous wall of capital waiting to be deployed. So we will see larger asset transactions this year, but I think very selectively.
So you're more bullish on the portfolio deal kind of side thing.
Yeah, and I think, as the market, again, churns, there's going to be more M&A in the space, certainly, when we have a better idea of sort of pricing on that basis. But, yeah, probably towards the end of this year.
I'm going to be cheeky. I'm going to talk about the technology space rather than the real estate side of things, since that's my forte, right? Within technology, B2B is one of the strongest growing and seeing most of the investment. Hospitality is the number one there. Hospitality being an inherently growth industry, like someone said on the panel, technology investment increasing. So we're seeing a lot of investment in the hotel B2B technology space. We'll see a lot of consolidation moving forward, a lot of M&A activity. Muse is one of the most active ones in terms of getting investment as well as M&A, but there's other players as well. So that will continue, and we'll continue to see more consolidation, where before there was a lot of point-to-point solutions where one player did one specific thing. We see more and more now that there's a few players that try to provide an all-in-one software solution, and we'll probably see more of that over the coming years.
Great. Do we have any questions for our panel from the floor? There's one up there. I'm going to run to you with the microphone. Just tell us who you are, where you're from.
Hello, it's Jana Mistry from Jefferies. I wanted to follow up, Rebecca, on what you said around, and actually what the panel said around single assets coming to market. Do you see that happening in the UK specifically? And is that distress or is a bid-ask spread narrowing from prices going up? And then secondly, around RevPAR in the UK, which has been specifically weak in the lower end segments, do you see this recovering in 2025?
Yeah, so the single asset deal point, we see a lot being tested. So again, when I go back to it's off market, it's never really off market. It's a lot of people have seen it. It's just not being openly marketed. I think a lot of vendors are checking to see where pricing might land, but they're not putting assets on the open market because they just don't want to take a massive hit on, valuation or whatever the case may be. But I think there's definitely been a shyness away from the top tier market in London at the moment where, $1 million, $1.5 million a key has been tricky. But I do think there's going to be more larger transactions as vendors become a bit more realistic on where pricing is.
And in terms, excuse me, of the RevPAR, we've definitely seen, to your point, a bifurcation of performance across the class spectrum. Luxury doing incredibly well, mid-scale and economy struggling far more to gain. If we look at our forecasts for the UK for mid-scale and economy for next year, next couple of years, growth, yes, but very, very minimal. I mean, it was 0.4% across Europe in the economy sector, but I think, UK specifically, minimal 1 to 2% RevPAR for 25 and beyond, really, the next few years. That's what we're forecasting.
Great. We can squeeze in one more, I think, if we have it. Oh, there we go. Just tell us who you are, where you're from.
Hello, I'm Martin Smith-Sivertsen from Citybox Hotels. It's about technology. We have used the automats to check in, check out for soon 20 years. We have half the labor cost, and we use that to better design, higher profit, higher rent. We want more hotels. But I think this industry is very, very slow in investing in their own hotels, running hotels, and in technology. So why do you think it will be so much better now?
I'm not saying it's going to be a split decision where all of a sudden it's going to be better. I think we're seeing momentum. We're starting to see, obviously, the technology getting better from a cloud point of view, and we're seeing a lot of older systems or legacy systems, if you want to call them that are moving to the cloud as well. So the on-premise solutions are being sunset, and so eventually, even if some hotels don't want to, they'll be in the cloud in a few years' time. They'll have to because there's no support for the on-premise systems anymore. We're starting to see the big chains like Wyndham and others really investing in technology and in some cases opening up some of their partnerships. So allowing the franchise holder or the franchisee to decide who do they work with in terms of technology. Wyndham is quite good at that, but there's other companies that are quite strict in what systems does a franchisee need to use. But that's starting to change as well. And once these big brands are doing that, a lot of others follow as well. So it's and last point related to that, I think, is AI. There's a lot of talk about AI. I think we're starting to now see real application of AI, and what can it actually do for hotels. Just as a quick example, we introduced a thing called Smart Tips in our property management system. So when a front desk agent is checking someone in, they'll see a little pop-up, tweet size, little summary of that person. If they've stayed with the hotel before and there's a note on the system in the housekeeping notes or maintenance notes or restaurant or front desk, this unstructured sort of notes page that you used to have is being summarized and something is being pulled out by AI to say this person had a bad experience in the restaurant last time, offer them a voucher, something like that. To give a real actionable insight to this front desk agent to offer something that otherwise they probably wouldn't have been able to do. so that they know it's a returning guest, they know they had some sort of experience last time, they can call that out in that split second that they have with that guest. And that's what technology can do today, and it's only going to improve over the next years and decades. So therefore, I feel that we're finally getting somewhere where technology can actually personalize the experience and make it better rather than it being an inhibitor. So yeah, that's why I'm positive.